Hey everyone, and welcome. Today we're diving into a really powerful tool for any investor's arsenal. It's a simple, 9-point checklist that's designed to figure out if a company is genuinely strong or if it's just, faking it. So let's jump right in.
Okay, so you've probably been here before, right? You find a stock and it just looks incredibly cheap. The price has been hammered down and you're thinking, this has to be the deal of a lifetime. But how do you really know? How can you be sure you've stumbled upon a hidden gem and you're not about to walk right into a financial landmine?
And that question leads us right into one of the biggest risks in investing, the dreaded value trap. Honestly, this thing has fooled even the smartest people on Wall Street, and it's exactly the kind of situation we all want to avoid.
So what exactly is a value trap? Well, it's a stock that looks cheap for a very, very good reason. The business itself is actually falling apart. That low price isn't an opportunity. It's a massive warning sign that the company's foundation is crumbling.
Okay, so that's the problem. How do you solve it? How do we separate the real bargains from the dangerous traps? Well, back in the year 2000, an accounting professor named Joseph Piotroski came up with a pretty brilliant filter to do exactly that. Let's break down his 9-point checklist.
And that system is called the F-score. It's super simple. It's just a scale from 0 to 9. A company gets 1 point for each of the 9 financial tests it passes. A higher score means a stronger, healthier company. Think of it like a report card for a company's financial health, based only on the numbers.
And the real beauty of this thing is its simplicity. Instead of getting swept up in market hype and stories, the F-score forces you to focus on the cold, hard, audited numbers. It gives you this really balanced snapshot of a company's health, its profits, its debt, and how efficiently it's run, all designed to help you dodge those nasty value traps.
All right, so let's pop the hood and see how this thing actually works. The 9 signals are neatly organized into 3 key categories. Each one gives us another piece of the puzzle about a company's true strength.
Okay, first up, and this is probably the most important part, is profitability. This category really asks the most fundamental question you can ask about any business. At the end of the day, is it actually making money and bringing in real cash?
So the 4 tests here are all about the quality of the company's profit. First, the basics. Is net income positive? You get a point for that. Is the company generating real cash from its operations? That's another point. But it goes deeper. A company also gets a point if its return on assets, or ROA, is improving. That just means it's getting better at making a profit with the stuff it owns. And this 4th point is crucial. A company gets a point if its real cash flow is greater than its reported net income. That is a huge sign of high-quality, trustworthy earnings.
All right, next up, the checklist dives into the company's balance sheet. How much risk is it carrying? We're talking about debt levels and whether it can actually pay its bills on time. So here, we're checking for financial risk with 3 tests. First, is the company's long-term debt going down? Less debt means less risk. Simple. Second, is its short-term liquidity getting better? Basically, is the company in a stronger position to pay its immediate bills? And the third point is really interesting. A company gets a point for not issuing new shares. Now, why is that good? Well, because when a company just prints a bunch of new stock, it waters down your ownership stake, and that's usually not a great sign for investors.
And that brings us to our third and final piece of the puzzle, operational efficiency. This is all about how well the company is using everything it has, its assets, its people, to generate sales. Is the business actually getting better and smarter at what it does?
And the last 2 tests look at how well the business is run. The first one checks for an improving gross margin. Just think of this as the core profit on every single thing the company sells. If that's going up, it usually means they have strong pricing power. The second test is for a higher asset turnover. This just means the company is squeezing more sales revenue out of every dollar of assets it owns. Put them together, and they paint a picture of a business that's becoming a lean, mean, profit-making machine. Okay, so that's the 9-point system. It sounds pretty smart on paper, right? But here's the million-dollar question for any investor. Does this checklist actually work? Does it lead to better results? Let's see what the evidence says.
Well, let's go straight to the source. Piotroski himself had a very specific goal. As he put it,
The score was designed to find the strongest companies within a big pile of cheap, financially beat-up stocks. In other words, its whole purpose was to find the diamonds in the rough. So in his original study, which spanned a full 20 years, he split all these cheap stocks into two groups: the ones with high F scores, the financially strong ones, and the ones with low F scores, which signaled weakness. And, well, their performance couldn't have been more night and day. And here is the result. Just look at this. The high F-score stocks didn't just do well, they absolutely crushed it, outperforming the market by an average of 13.4% per year. Meanwhile, the low F-score stocks, yep, those are our value traps, they got hammered, dramatically underperforming.
So let's just let that sink in for a second. The gap in performance between the best stocks and the worst stocks was a massive 23 percentage points every single year. This wasn't a small statistical quirk. This was a huge game-changing edge.
Okay, that history is pretty convincing. But that was then. What about now? How can we actually take this score and apply it in today's market? Let's bring this into the present. Using it today is actually really straightforward. Here's how to think about the scores. If you see a score of 8 or 9, you're likely looking at a company with rock-solid fundamentals. On the other hand, a score between 0 and 2, yeah, that's a red flag. It signals weak fundamentals and probably a lot of risk. And I want to be clear, this isn't some old, dusty theory from a textbook. The F-score is a living, breathing tool that investors and major screening websites are using right now all over the world, from Wall Street to the Nifty 500 in India, to filter for quality companies. Okay, and this is super important, you can't think of the F-score as some kind of magic bullet that picks winning stocks. It's best used as a filter. It's the bouncer at the club that checks for quality. It tells you if a cheap-looking company is financially strong, but it doesn't tell you if it's still a good value. That's why you always combine it with valuation metrics like the price-to-book ratio. The F-score is your quality check before you decide if the price is right.
So let's wrap this up with one final thought. In a market that's filled with noise and uncertainty, could this simple 9-point checklist be your best defense against walking into the next value trap?